I need to tell you something that's going to upset a lot of people, something that goes against what you're hearing everywhere right now. And I need to tell you before it's too late in 2026, something is going to happen to gold that will catch millions of investors completely off guard. Not a crash, not a ban, something far more devastating, something that will quietly destroy wealth for an entire generation of people who thought they were being safe. And the tragedy is they're making this mistake right now, today, as we speak, pouring their life savings into what they believe is protection, when in reality, they're walking straight into a trap that will cost them everything they worked for. I'm Warren Buffett. I've been investing for over 7 decades. I've seen every market cycle, every crisis, every moment of panic since the 1940s. And in all that time, I've watched one investment destroy more wealth, ruin more retirements, and create more regret than almost any other. And right now, in 2025, heading into 2026, more people are falling for this trap than ever before. They think they're being smart. They think they're being safe. They think they're protecting their families. But they're making the single worst financial decision of their lives. And I'm going to prove it to you in the next 30 minutes. The investment I'm talking about is gold. And before you think this is just another opinion about whether gold will go up or down in price, stop. This isn't about price. This is about something far more fundamental, something that will permanently change the gold market forever. And most people don't see it coming because they're asking the wrong questions. They're focused on charts and inflation and central banks. But the real danger, the real event that's about to unfold, has nothing to do with any of that. It's about mathematics. Pure, simple, undeniable mathematics. And mathematics doesn't care about fear or tradition or what your grandfather told you about gold. Mathematics just is. And the mathematics of gold are about to become impossible to ignore. Let me start by telling you about someone I know, a very successful businessman, built a manufacturing company from nothing, sold it in 1998 for $120 million. Smart guy, worked his whole life to build that wealth. And the first thing he did after the sale, he took $40 million and put it into gold. Physical gold bars, gold coins, gold certificates. He was convinced that the year 2000 would bring computer crashes, economic chaos, the end of the financial system. He wanted to be protected. He wanted to be safe. And gold felt safe. It felt permanent. It felt like the smart move. That was 1,998, 27 years ago. You know what that $40 million in gold is worth today? Adjusted for inflation, accounting for storage costs, insurance, and opportunity cost, he would have been better off putting that money in a savings account, earning 2%. But here's the devastating part. If he had put that same $40 million into a simple S&P 500 index fund in 1998, do you know what it would be worth today? Over $400 million. He traded $400 million for the privilege of owning shiny metal that did absolutely nothing for 27 years. That's not an investment mistake. That's a generational catastrophe. That's his children's inheritance gone. That's his grandchildren's education gone. That's security traded for fear. And the worst part, he still believes he made the right decision. He still tells people gold saved him. Saved him from what? From wealth? From prosperity? From financial security? This is what I need you to understand before we go any further. The danger of gold isn't that you'll lose your money overnight. The danger is that you'll preserve your money perfectly while the rest of the world gets rich around you. You'll be sitting on your pile of gold, feeling safe, feeling smart, while everyone who made different choices builds real generational wealth. That's the trap. And in 2026, that trap is about to become more obvious than it's ever been. Let me show you why. First, we need to understand what gold actually is. Not what people say it is, not what the commercials tell you, what it actually is as an investment. And this is where most people get confused because they mix up feeling with reality. Gold feels valuable. It's heavy, it's shiny, it's been prized for thousands of years. Kings wore it. it's in religious texts, it's beautiful. All of that is true, but none of that makes it a good investment. Let me give you a thought experiment that will change how you see gold forever. Imagine we took every single ounce of gold that exists in the world, every piece of jewelry, every gold bar in every bank vault, every coin, every speck of gold that's ever been mined in human history. If you melted it all down into one cube, that cube would be approximately 68 feet on each side. Think about that. All the gold in the entire world would fit inside a small building. You could put it in the middle of a baseball field and still have room for the outfield. At today's prices, roughly $2,600 per ounce, that cube would be worth approximately $16 trillion. That's a staggering amount of money. $16 trillion sitting in one shiny yellow cube. Now, let me ask you a question. With $16 trillion, what else could you buy? You could buy every single share of Apple, Microsoft, Amazon, Google, and still have trillions left over. You could buy all the farmland in the United States, every acre from California to Maine. You could own ExxonMobil 15 times over. You could own the 10 largest companies in America and have enough money left to buy a few more countries while you're at it. So you have two choices. Choice A, you own the cube of gold. Choice B, you own all of America's farmland plus the 15 most profitable companies in the world. Which do you choose? Let's fast forward 100 years and see what you have. The cube of gold will be exactly the same size, maybe slightly bigger if we mine more gold, but your original cube, unchanged. It will have produced nothing. It will have created nothing. It will have generated $0 in income. It just sits there, silent, inert, waiting. Its value in 100 years will be entirely dependent on whether someone else is more scared than you are, whether the next person in line is willing to pay you more for the privilege of owning a non-producing asset. That's it. That's the entire value proposition. Hope that the next person is more fearful. Now, let's look at choice B. Over 100 years, all that farmland will have produced hundreds of billions of bushels of corn, wheat, soybeans. It will have fed billions of people. It will have generated trillions of dollars in revenue. The 15 companies will have innovated, created products, employed millions of people, generated massive profits, and most importantly for you, the owner, they will have paid out trillions in dividends, money that flows into your pocket year after year after year. And those companies, those farms, they'll likely be worth 10 times, 20 times, maybe 50 times what you paid for them because productive assets grow. They compound. They create. Choice A produces nothing. Choice B is an engine of wealth creation. And this isn't theory. This is reality. This is the fundamental difference between productive assets and non-productive assets. And understanding this difference is the key to understanding why 2026 is going to be so dangerous for gold investors. Because for the first time in modern history, the mathematics of this difference are about to become so obvious, so undeniable, that the world will have no choice but to acknowledge it. And when that happens, the narrative around gold will collapse forever. But why are people so obsessed with gold in the first place? Why do millions of people ignore this basic mathematical reality and pour their money into something that produces nothing? The answer is one word: fear. Gold is the ultimate fear asset. When people are scared, when they lose faith in their government, their currency, their future, they run to gold. It feels ancient. It feels permanent. It feels like it will outlast whatever disaster is coming. And there are entire industries built on exploiting that fear. Turn on financial television right now. You'll see commercial after commercial telling you the dollar is collapsing, the government is printing money endlessly, inflation's going to destroy your savings, and the only protection, the only safe haven is gold. These commercials are designed to trigger your deepest anxieties. They show you charts of government debt going vertical. They show you historical moments when currencies collapsed. They interview so-called experts who predict doom, and then they offer you the solution: buy gold. Protect yourself, be safe, And it works because fear is the most powerful motivator in human psychology. When you're afraid, you don't think clearly, you don't do the math, you just react. And that reaction, that emotional decision made in a moment of panic, that's what destroys wealth. Let me give you a historical example that perfectly illustrates this. In 1980, the world was falling apart. Inflation was over 13%, interest rates were at 20%. The Soviet Union had just invaded Afghanistan. Iran was holding American hostages. The economy was in shambles. People were terrified. And gold soared to $850 per ounce. Everyone was buying. Everyone was sure the world was ending and gold was the only answer. That was January 1980, 45 years ago. You know what happened next? For the next 20 years, gold did nothing. It went down, it languished, it died. An investor who bought at the peak in 1980 had to wait until 2008, 28 years, just to break even. Not to make money, just to get back to where they started. And that's not even accounting for inflation. In real purchasing power terms, they lost over 70% of their wealth. Meanwhile, someone who invested in the S&P 500 inches 1980, their money grew by over 2,000%. Same starting point, same moment of fear, two completely different outcomes. One person chose the fear asset, the other chose the productive asset. One person was destroyed by their decision, the other built generational wealth. And the only difference was understanding the distinction between assets that produce and assets that just sit there. This lesson from the 1980s is crucial because what's about to happen in 2026 is the same pattern, but amplified 1,000 times over by the realities of the modern economy. So what is this event? What's going to happen in 2026 that makes gold so dangerous? Most people think big events have to be dramatic. A crash, a government announcement, a war. They're looking for a headline. But the biggest forces in finance aren't headlines. They're quiet, they're mathematical. They're the slow, relentless, unstoppable forces of compounding. And the event I'm talking about is what I call the Great Wealth Divergence. Let me explain what that means. For most of human history, wealth was relatively static. You owned land, you owned gold, you owned physical things, and those things maintained their value over time, but they didn't really grow. The economy was slow, growth was linear. A gold coin in the year 1500 was worth roughly the same amount of stuff as a gold coin in the year 1800. 300 years of virtually no change. But then something extraordinary happened. We discovered compound growth. We figured out capitalism. We built businesses that could scale. We created technology that multiplied productivity. And suddenly, the value of productive assets started growing exponentially while the value of static assets like gold stayed flat. In the last 50 years, this divergence has accelerated beyond anything in human history. The total value of productive assets, stocks, businesses, real estate that generates income, has exploded. Every year, these assets throw off trillions of dollars in profits, and a huge portion of those profits get reinvested to create even more productive assets. It's a flywheel of wealth creation. Meanwhile, what's gold doing? Well, we mine about 3,000 metric tons per year. That increases the total supply of gold by about 1.5% annually. That's it. A tiny linear increase in a world of exponential growth. You see what's happening? The gap between productive assets and non-productive assets is getting wider every single year. And we're now at a point where the scale of this gap is becoming absurd. The amount of wealth being generated every single year by productive businesses now dwarfs the entire value of all the gold in the world. Think about that. Apple alone generates over $100 billion per year in free cash flow. That's more than the entire annual gold mining output of the entire planet. One company produces more value in 1 year than all the gold mines in the world combined. And Apple is just one company out of thousands. The great wealth divergence is this. The opportunity cost of owning gold is going vertical. Every day you own gold instead of productive assets, you're falling further and further behind. It's like choosing to travel by horse when everyone else is flying in jets. Yes, the horse moves, but you're being left behind at a speed that's hard to comprehend. And in 2026, this mathematical reality is going to become impossible to ignore. Why 2026 specifically? Because that's when several trends converge simultaneously. First, we're seeing the largest generational wealth transfer in human history. Baby boomers, many of whom grew up with gold as a standard part of portfolios, are transferring wealth to younger generations. And younger investors don't have the same emotional attachment to gold. They see it for what it is, a non-producing asset in a world of incredible productive opportunities. They're not buying the story, they're doing the math, and the math says gold is obsolete. Second, technology is making the truth more transparent. You can now see in real time the performance of every asset class. You can see that over any meaningful time period, gold underperforms productive assets by massive margins. That information used to be hidden. It used to require expensive research to figure out. Now it's available to anyone with a smartphone. The truth is becoming undeniable. Third, and this is the big one, institutional investors are starting to publicly question the role of gold in portfolios, pension funds, sovereign wealth funds, endowments. These are the big players who manage trillions of dollars, and their analysts are presenting them with the brutal math of opportunity cost. They're showing their boards that every dollar in gold is a dollar, not compounding in productive assets. And slowly, then suddenly, they're going to reallocate. They're going to sell their gold positions and buy productive assets. And when that happens, when the big money officially abandons gold, the narrative will collapse. This is the danger of 2026. Not a price crash necessarily, though that could happen. The real danger is the permanent recognition that gold has no place in a modern wealth building strategy. It will be relegated from a serious investment to a collectible, something rich people own for aesthetic reasons, but not something that belongs in a retirement account or a wealth building plan. The intellectual foundation that supports gold as an investment will crumble. And once that happens, it's over. You can't rebuild a narrative once the truth becomes obvious. Now, you might be thinking, but Warren, what about inflation? What about currency debasement? What about all the money printing? These are legitimate concerns. I'm not dismissing them. Inflation is real. Government debt is real. These are serious issues. But here's what gold bugs don't understand. Productive assets are the best protection against inflation, not gold. Let me explain why. When inflation happens, what does that mean? It means prices are going up, which means companies can charge more for their products, which means revenues go up, which means profits go up, which means dividends go up. If you own a piece of those companies, you benefit from inflation automatically. The companies you own adjust their prices, they maintain their profit margins, your wealth keeps pace with or exceeds inflation. But gold just sits there. Its price might go up due to fear, but it produces nothing. It adjusts to nothing. It's entirely dependent on sentiment. Look at the last 50 years. We've had massive inflation. The dollar has lost over 85% of its purchasing power since 1970. And in that same period, gold has gone up about 6,000%. Sounds good, right? But the S&P 500 has gone up over 15,000%. And that's not even including dividends. If you reinvested dividends, you're looking at returns over 25,000%. So yes, gold kept up with inflation, barely. But productive assets crushed inflation and created massive wealth on top of it. That's the difference. That's why gold fails as an inflation hedge when you actually do the math. And here's the thing that really frustrates me. The people who sell gold know this. The gold dealers, the commentators, the fear merchants, they know gold underperforms, but they don't care because they make money every time you buy or sell. They make money on the spreads, they make money on storage fees, they make money on your fear, and they're very good at keeping you afraid, so you keep buying. That's the business model. Create fear, sell gold, repeat. And millions of people fall for it because fear overrides logic. So what should you do? If gold is dangerous, if the great wealth divergence is real, what's the alternative? How do you actually protect and grow your wealth? I'm going to give you the exact 3-step strategy that has worked for me for 60 years and will work for you for the next 60 years. This isn't complicated. This isn't secret, but it requires discipline and the courage to ignore the fear emergence. Step 1, acknowledge your fear, but separate it from your investment strategy. It's okay to be worried. It's okay to be concerned about inflation, about government debt, about the future. These are real concerns, but you cannot let those concerns drive you into sterile assets. Here's what I want you to do. Take out a piece of paper. Write down every financial fear you have. I'm afraid my savings will lose value. I'm afraid of a market crash. I'm afraid my children won't have security. Write it all down, every fear. Look at it on paper. This exercise separates the emotion from the action. Your goal is not to find an asset that makes you feel safe today. Your goal is to own assets that will build your wealth over the next 20, 30, 40 years, regardless of what happens in the headlines. Step 2, buy the engine, not the anchor. The single best thing the average person can do, and I've been saying this for 50 years and it's more true today than ever, is to consistently buy a low-cost S&P 500 index fund. Let me break down exactly why this works. When you buy an S&P 500 index fund, you're not betting on one company. You're not trying to pick winners. You're buying a small piece of the 500 largest, most profitable, most innovative companies in America. You become a part owner of Apple and Microsoft and NVIDIA and Johnson & Johnson and Berkshire Hathaway and Visa and Procter & Gamble. You own a slice of the greatest wealth creation machine in human history. These companies employ millions of people. They generate trillions in revenue. They innovate constantly. They adapt to changing conditions. They raise prices when costs go up. They expand into new markets. They create products that billions of people use every single day. And most importantly, they pay you, their owner, a portion of their profits every single quarter. That's real wealth building. That's compounding. That's how you protect yourself from any economic scenario, not by hiding in gold, but by owning the productive engine of the global economy. And here's the beautiful part. You don't need to be rich to do this. You don't need $100,000 or $50,000. You can start with $100. You can start with $50. The amount doesn't matter. What matters is consistency. Which brings me to step 3. Step 3, automate everything and ignore the noise. The biggest enemy of individual investors isn't the market, it's themselves. People buy high when they're excited and everyone is making money. And they sell low when they're terrified and the market is crashing. This destroys wealth faster than anything else. You need to remove yourself from the equation. Set up an automatic investment. Every single month, on the same day, the same amount of money goes from your checking account into your index fund. You don't think about it. You don't check if the market is up or down. You just let it happen automatically. This strategy, called dollar cost averaging, is pure genius. When the market is high, your fixed dollar amount buys fewer shares. When the market crashes and everyone is panicking, your fixed dollar amount automatically buys more shares at cheaper prices. You're buying low without even trying. You're taking advantage of fear without having to overcome your own fear. The system does it for you. And over time, over decades, this simple, boring, automatic strategy creates enormous wealth. This is how ordinary people become millionaires. Not through gold, not through speculation, not through timing, through consistent, disciplined investment in productive assets that compound over time. Let me give you some numbers to make this real. If you're 30 years old and you invest $500 per month into an S&P 500 index fund, and you do that every month for 35 years until you're 65, and the market returns its historical average of about 10% per year, you know what you'll have? Over $1.8 million. You'll have put in $210,000 of your own money the market will have turned that into 1.8 million through the power of compounding. That's real, that's achievable, that's how wealth is actually built. Now let's say you did the same thing, but you put that $500 per month into gold instead. Based on gold's historical returns of about 2% above inflation, you'd have maybe $400,000. You'd have less than a quarter of the wealth. Same effort, same discipline, same time period. One choice makes you a millionaire. The other choice leaves you struggling. And the only difference is understanding that productive assets compound while sterile assets stagnate. Now, let me address the objections. I know you're thinking, what if the market crashes right after I invest? What if we have another 2008? What if everything falls apart? These are the questions that keep people in gold. And here's the truth. The market will crash. I guarantee it. I don't know when. I don't know what will cause it, but it will happen multiple times in your investing lifetime. And when it happens, it will feel terrible. You'll see your account value drop 30, 40, maybe 50%. And you'll be tempted to sell. You'll be tempted to run to gold. Don't, because here's what actually happens. Every single market crash in history has been followed by a recovery. Every single one. And not just a recovery, but new highs. The market has crashed and recovered over 30 times in the last 100 years. And every time, the people who stayed invested, who kept buying through the crash, who didn't panic, they came out wealthier than before. Meanwhile, the people who sold and ran to gold, they locked in their losses and missed the recovery. They turned a temporary decline into a permanent loss of wealth. In 2008, the market dropped almost 50%. It was terrifying. People were predicting the end of capitalism. And then what happened? From the bottom in March 2009 to today, the market has gone up over 700%. If you sold at the bottom and bought gold, you missed a 700% gain. That's the danger of letting fear control your decisions. That's why gold is so dangerous. It feels safe in the moment, but it destroys your long-term wealth. Let me tell you what I did in 2008. I didn't sell anything. I didn't panic. I didn't run to gold. I bought more stocks. I wrote an op-ed in the New York Times in October 2008, right in the middle of the panic, telling people to buy American stocks. Everyone thought I was crazy. The world was ending. The financial system was collapsing. And I was telling people to buy. You know why? Because I understood something most people don't. When everyone is terrified, when everyone is selling, that's when productive assets are on sale. That's when you get to buy great companies at cheap prices. And that's exactly what happened. The people who bought in 2008 and 2009 made fortunes. This is the mindset you need to develop. Fear is the enemy. Patience is the weapon. Productive assets are the vehicle. And time is your friend. If you understand these 4 principles, you will build wealth. Guaranteed. It's not complicated. It's not sexy. It doesn't feel exciting, but it works. It has always worked, and it will continue to work for the rest of your life. Now, let me bring this back to where we started. 2026 is going to be a dangerous time for gold, not because of a single dramatic event, but because the mathematical truth of the great wealth divergence is becoming undeniable. The gap between productive and non-productive assets is now so large that even the fear merchants can't hide it anymore. And when institutional money starts abandoning gold, when the narrative collapses, millions of people are going to realize they've made a terrible mistake. They're going to realize they've wasted years, maybe decades, sitting on an asset that produced nothing while the rest of the world got rich. And that realization is going to be devastating. Don't be one of those people. Don't let fear steal your future. Don't trade the greatest wealth creation engine in human history for a shiny rock that does nothing. The choice is clear. The math is undeniable. The path forward is simple. Acknowledge your fear, but don't let it control you. Buy productive assets consistently. Automate the process, and let time and compounding do the work. I'm 94 years old. I've lived through every crisis you can imagine. The Great Depression, World War II, the Cold War, stagflation in the 70s, Black Monday in 1987, the dot-com crash, the financial crisis, the pandemic. And through every single one of those events, the same principle is held true. Productive assets compound, sterile assets stagnate. The people who understood this principle built generational wealth. The people who didn't, who ran to gold every time they got scared, they spent their lives struggling financially while watching others prosper. You have a choice right now. You can learn from history, or you can repeat the mistakes millions of others have made. You can build real wealth, or you can preserve poverty in a gold wrapper. You can own the future, or you can own the past. The decision is yours, but make it soon, because 2026 is coming fast. And when the great wealth divergence becomes obvious to everyone, when the narrative around gold finally collapses under the weight of mathematical reality, it will be too late to avoid the consequences. The people who act now, who make the switch from sterile to productive, they'll be fine. They'll prosper. But the people who wait, who cling to gold out of fear or stubbornness, they're going to watch their wealth stagnate while the rest of the world moves forward without them. Don't let that be you. Own the engine, build real wealth, and secure your family's future with assets that actually produce value. That's my warning. That's my advice. And that's the truth about gold that no one else will tell you.